to our regular Chart TV episodes. Today we're going to take a bit of a look at the sort of research I've been conducting. You may be aware that I've been conducting research on the intraday price movements of certain markets, and I just thought I'd share some of my observations and discoveries with you and point the way as to how to conduct your research. This sort of research, I haven't really read anywhere of anyone doing this sort of thing, and I think it's a bit of a different way to look at the markets, and the insights it has provided me are invaluable, and I think that the insights it could possibly provide you would also be invaluable for your particular market. I've only used it on one market, but I imagine that it would work across a whole range of markets. That's for you to decide and for me to later discover, I guess. Anyway, what I do is basically you get an intraday chart such as this chart here. This is the market I'm interested in at the moment. And what I do is I mark down the low, which the time of the low, which occurred at about roughly 11 o'clock, which I found it rather interesting that it reversed exactly at bang on 11 o'clock. And the high time for this market, which was about 12:30, we can see here. It's not. I don't tend to be that exact to the second, but you can be if you like. It's up to you. Now, what we do is we go and put this data into a spreadsheet, and as I said before, I don't think that you can really purchase this sort of data. I think it's sort of data you have to make for yourself, which is fantastic, because this means that if you build a system around this, you know, like you know the data well, you know what it's about and what you're trying to discover with this data. You're not just going off someone else's opinion or someone else's calculations. These are your calculations. So what I've done is I've just got a Microsoft Excel spreadsheet, and what I've done is I've put in the daily range, so I get an average for the market. Now, I'm not going to go through the common Excel formulas. There's a million books and programs out there and courses out there that'll show you how to use Excel. And the features I use, there's nothing fancy or special. I just get a daily average. I get an average for this, and I'm looking at the daily range. It turns out that the average for this market is a 35-point range. I then note down the low time, which in this case was 11 a.m. And then I note down the high time, which in this case was 12:30 a.m. The PM, sorry. Now, the interesting thing that I've done here is I've divided. This market has a 6-hour trading session, and what I've done is I had the hypothesis that the market tends to make extremes of range. That is, the highs and lows for the days in either the first half an hour or the last half an hour of trade. Dr. Alexander Elder, in Trading for a Living, often talks about amateurs opening the market and professionals closing it. If that's the case, then you're going to see it's going to indicate. They're going to leave their footprint on the market when they do make their move. So and most of the volume comes into the market. What happens is, and I've talked about this before, is that a lot of traders are not full-time traders and can't afford to sit in front of the trading screen all day, unlike brokers and professional traders. Millions of people across the world hold down regular day jobs, and they make their trading decisions when they get home from their day job. They read the newspaper or watch a TV news or listen to the radio or surf the internet and get their trading decision. They may make it the night before the next trading session the market opens, and we're usually talking about stock markets here because forex markets are pretty much 24/7. But with stock markets, people tend to make their trading decision the night before or the morning just before the market opens. And what happens is you'll find all these orders bank up just before market open. So if most of the volume of trades is done just after the market opens, it stands to reason that with the greatest volume, you're going to get the greatest price movement. So you're going to get your high or your low for the day. That's all great in theory, but how do you prove this? How do you statistically verify this? And what I've done here is try to find out exactly whether this theory holds any real value. Is it true, or is it just a theory? So what I've done here is I've divided this market session it's the 6-hour session into 12 half-an-hour slots. And I've gone through and numbered them 1 through 12. So the first half an hour, 10 a.m. to 10:30 a.m. is 1, 10:30 to 11 is 2, and so on and so forth, right up to 12. Hang on. Hold on a tick. Alright. So what I've done here now is I've gone and run a count, and you can see on the values, and you can see that out of 100 137 recordings. The low was made 68 of those 137 times. I don't have the percentage here, but that's roughly over 50%. And the high was often made in the first half an hour, once again about just under 50% of the time. Is this statistically significant? Yes, I believe so. Obviously, with larger sample sizes, say I'd narrow this down into 24 periods or 48 or whatever, however many you want to do, I believe you can get some very good research on when a market is likely to make an extreme high or an extreme low of range. What does this mean? It means that if you've got a trading system and you say you've been looking at end of day charts and you can see that a stock is in a uptrend or downtrend, and you want to position yourself, you want to find the optimum time of day to buy or sell, to enter this trade or enter this position, with research like this, you can determine that time on a daily chart. So I think it's very handy and it's invaluable, and it's my gift to you here on Chart TV. Please feel free to go ahead and conduct research like this, or based on like some of similar sort of thinking on your own markets. I'm Malcolm Gordon. Thanks for watching Chart TV. I'll see you next time.